Peter Barnes, Fox Business, sir. You mentioned fiscal issues in the statement today. Are you concerned about a government shutdown? We're hearing more about that possibility. Did that come up in your discussions at this meeting? What do you think would be the impact of a government shutdown on the economy? And what could the Feds be, or would the Fed be prepared to respond to that and help the economy with additional accommodation, for example, additional asset purchases? Thank you.
Well, a factor that did concern us, as in our discussion, was some upcoming fiscal policy decisions. I would include both the possibility of a government shutdown, but also the debt limit issue. These are obviously, part of a very complicated set of legislative decisions, strategies, battles, et cetera, which I won't get into. But it is the case, I think, that a government shutdown, and perhaps even more so a failure to raise the debt limit, could have very serious consequences for the financial markets and for the economy. And the Federal Reserve's policy is to do whatever we can to keep the economy on course. And so if these actions led the economy to slow, then we would have to take that into account, surely. So this is one of the risks that we are looking at as we think about policy. That being said, our ability to offset these shocks is very limited, particularly a debt limit shock. And I think it's extraordinarily important that Congress and the administration work together to find a way to make sure that the government is funded, public services are provided, that the government pays its bills, and that we avoid any kind of event like 2011, which had, at least for a time, a noticeable adverse effect on confidence and on the economy.
With CNN Money. This week marks 5 years since the financial crisis began, and Hank Paulson, who you've worked very closely with, has said his biggest regret was that he wasn't able to convince the American people that what was done, the bank bailouts, weren't from Wall Street, they were from Main Street. What is your biggest regret as you reflect on the 5-year anniversary? And do you believe that the Fed, Congress, and the President have put the necessary measures in place to prevent another deep financial crisis?
Well, on regrets, as Frank Sinatra says, I have many. I think reasonably, the biggest regret I have is that we didn't forestall the crisis. I think once the crisis got going, it was extremely hard to prevent. I think we did what we could given the powers that we had, and I would agree with Hank that we were motivated entirely by the interest of the broader public, that our goal was to stabilize the financial system so that it would not bring the economy down, so that it would not create massive unemployment and economic hardship that was even more, would have been even more severe by many times than what we actually saw. So I agree with him on that, and I guess since you gave me the opportunity, I would mention that, of course, all the money that was used in those operations has been paid back with interest, and so it hasn't been costly even from a fiscal point of view. Now, in terms of progress, that's a good question. I think we made a lot of progress. We had, of course, the Dodd-Frank law passed in 2010, and then we recently, have come to agreement internationally on a number of measures, including Basel III and other agreements relating to the shadow banking system and other aspects of the financial system. I think that today our large financial firms, for example, are better capitalized by far than they were certainly during the crisis and even before the crisis. Supervision is tougher. We do stress testing to make sure that firms can withstand not only normal shocks, but very, very large shocks similar to those that they experienced in 2008. And very importantly, of course, we now have a tool that we didn't have in 2008, which would have made, I think, a significant difference if we had had it, which is the orderly liquidation authority that the Dodd-Frank bill gave to the FDIC in collaboration with the Fed. Under the orderly liquidation authority, the FDIC, with other agencies, has the ability to wind down a failing financial firm in a way that minimizes the direct impact on the financial markets and on the economy. Now, I should say, I don't want to overstate the case. I think there's a lot more work to be done. In the case of resolution regimes, for example, the United States has set the course internationally. Other countries and international bodies like the FSB are setting up standards for resolution regimes, which are very similar to those in the United States, which is going to make for better cooperation across borders. But we're still some distance from being fully geared up to work with foreign counterparts to successfully wind down a international, multinational financial firm. And we made progress in that direction, but we need to do more, I think. So I think there's more to be done. There's more to be done on derivatives, although a lot has been done to make them more transparent and to make the trading of derivatives safer. But it's going to be probably some time before, all of this stuff that has been undertaken, all of these measures are fully implemented, and we can assess, the ultimate impact on the financial system.
Steve Beckner of MNI, Mr. Chairman. A number of economists and indeed some of your Fed colleagues have argued that the effectiveness of quantitative easing has greatly diminished, if not disappeared. And they point to the recent performance of the economy as proof of that. And there have been a number of people who have argued that there are regulatory and other impediments to growth beyond the reach of monetary policy. To what extent are these valid arguments? And if the economy does not speed up, if it does not reach your objectives, how will you ever get out of quantitative easing?
Well, on the effectiveness of our asset purchases, it's difficult to get a precise measure. There's a large academic literature on this subject, and they have a range of results, some suggesting that this is a quite powerful tool, some that it's less powerful. My own assessment is that it has been effective. If you look at the recovery, you see that some of the strongest sectors, the leading sectors like housing and autos, have been interest-sensitive sectors, and that these policies have been successful in strengthening financial conditions, lowering interest rates, and thereby promoting recovery. So I do think that they have been effective. You mentioned that there hasn't been any progress. There has been a lot of progress. As I said at the beginning, labor market indicators, while still not where we'd like them to be, are much better today than they were when we began this latest program a year ago. And importantly, as referenced in our FOMC statement, that happened notwithstanding a set of fiscal policies which the CBO said would cost between 1 and 1.5 percentage points of real growth and hundreds of thousands of jobs. So the fact that we have maintained improvements in the labor market that are as good or better than the previous year, notwithstanding this fiscal drag, is some indication that there is at least a partial offset from monetary policy. Now, just as you say, there are a lot of things in the economy that monetary policy can't address. They include the effectiveness of regulation. They include fiscal policy. They include developments in the private sector. We do what we can do, and if we can get help, we're delighted to have help from other policymakers or from the private sector, and we hope that will happen. The criterion for ending asset purchases is not, some very high rate of growth. What it is the criterion. Let me just remind you, the criterion is a substantial improvement in the outlook for the labor market, and we have made significant improvement. Ultimately, we will reach that level of substantial improvement, and at that point, we will be able to wind down the asset purchases. Again, and I think people don't fully appreciate that we have two tools. We have asset purchases, and we have rate policy and guidance about rates. It's our view that the latter, the rate policy, is actually the stronger, more reliable tool. And when we get to the point where where we are close enough to full employment that rate policy will be sufficient, I think that we will still be able to provide, even if asset purchases are reduced, we will still be able to provide a highly accommodative monetary background that will allow the economy to continue to grow and move towards full employment.